And so you can really say that they really even haven't begun a wholesale easing process, that they've stopped the rot for now. And that makes me think, and we've talked about this before, but that makes me think that the government bond curve does come all the way down, and maybe it's 20 basis points flat all the way out to 30 years, or maybe it's 10 basis points. Now, I don't think for an institution that's a great bet to buy bonds at 60 bips for a move to 30 or 20 or 0. I think in that kind of environment, they're going to need more protection, a different type of hedge than just government bonds. And I mention this, and I get into this now because I think we're beginning to. There's a sort of a new narrative that may be just developing, which is that government bonds as an asset class are losing their efficiency or productivity. Once we get down to 0, I think it gets very hard for bonds in the portfolio to act as the hedge. And I'm thinking, again, for portfolios that are 70-30, 65-35, and that I think there begins to be a little bit of a possible transition towards gold, which doesn't have a cap on it. It has an unlimited upside in a period where the authorities are going to be adding stimulus for a long time.
It makes sense, because bonds just don't offer there's no capital gains now. So all it does is act like cash. Well, fine, you use cash then. There's no point having a bond market. So you're right. You need something that can offset with gains to create that all-weather style portfolio or a portfolio hedge of some sort, because it's not bonds.
Just think about the move since 1980. I mean, every time we've had to downdraft in the periods we were discussing before, there were massive gains in bonds. I mean, you and I both in early 2000, I mean, I was loaded up on 2 years. The whole year was made on US 2-year notes. And that goes for every time we had one of those periods. And so that would offset the losses on the asset side of your portfolio. We don't have that now. I mean, I think if there's an existential crisis from an investor standpoint, again, putting aside the virus and the oil and all of that, is that in the next 5 years, what can replace bonds?
Well, if you're a pension fund manager, and I know you sit on an advisory board of an endowment or whatever it is, right? These are real meaningful questions now that everybody's going to have is, and I don't know the answer. We should think about this because Europe and Japan have gone through this. How did their pension system cope, and what did they do?
Well, they've gotten killed. I mean, I know German insurance companies, they have to put their money into negative bunds, and they have to pay out what they have to pay out based on their policy. So I don't know. Maybe the central bank is supporting that industry. I really don't know.
It makes me think that most people just leave the equity market. Because if you don't have a way of taking intelligent, balanced risk over a long-term time horizon, and if I look at the European stock markets and the Japanese stock markets, they obviously never recovered again, right? Which is one of my core theses, that I don't think the US market recovers for an extraordinary time until the demographic blows through. Because a part of this, I mean, how do you run intelligent risk in an equity portfolio for a pension now? It's difficult.
Where does it go then? I mean, this is the common refrain, right? If you pull from the equity, are you putting it into commercial real estate and hoping that you'll make some, return? I mean,
or do you get the government to guarantee the pension system and you just put it into cash? It's all going to end up in the government balance sheet and the central bank balance sheet in the end, whichever way you cut it, right?
It could. I also think that's a very long-term thing. That doesn't happen overnight. For the equity market to become not a place, where you can have exposure to the asset side, to assets, and to growth in the economy. I don't know even what's liquid enough. What's liquid enough to replace that? I understand what you're saying. You would need the government and also industry and business to say the equity markets don't work for us. We need it all guaranteed. I mean, that's really, you're very close to a socialist a socialist
but it is
system.
what the Japanese are doing, right? So they're buying their bond market because it's on the books of the pension funds and the life insurance companies.
I missed that. You said Europeans?
Sorry, the Japanese are
Japanese,
buying the ETFs, which are basically the equity portfolios of the life insurances and the pension funds to try and prop up returns because there's no bond return. I mean, it becomes a very complicated world because we've all made promises we actually can't match because all of the promises the entire pension system was built on never once assumed that bond yields were at zero in the point that you're raising.
Right, but how about a different thought? How about, we always talk about all this debt, et cetera. And I remember in the mid 80s and late 80s, people talking about how Reagan had leveraged up too much. We'd had too much debt, and that the U.S. economy, I think there was a book, Day of Reckoning or something like this, that it was going to default and all of this business. And what ended up happening in the 90s was that we reflated the asset side of the balance sheet, of the country's balance sheet. So maybe when we think about what are the models, the frameworks of the future, maybe it's they've gone unlimited right away. Maybe you're right. People may not. Maybe the government is going to support the equity markets to a greater degree than we could ever imagine. How much pressure is the debt side of the balance sheet if, let's say, the S&P doubles from here? Let's say the next 3 years, maybe, often you get inflationary episodes after there's a panic spike that forces the hands of authorities. I mean, it's not impossible that we have an inflationary episode where the real value of the S&P doesn't go up. The nominal value of the S&P goes up.
Yeah.
Right? And
I get it.
And also connected to this, and this is maybe something contrary to what you've been thinking, is that, look, Americans only care really about the equity market. Now, no one cares about the value of the currency. And, this is a perfect situation where if the dollar went down 20, 30% here, wouldn't be that big a deal, especially if it didn't happen, if it happened over time. And I would say most Americans wouldn't care, wouldn't know, it wouldn't matter. I think over a 5-6 year period, you could probably have it go down 50%. Look, it went down from 2000 to 2003. That was a huge run for macro guys like us, that dollar sell-off. And it was because of that dollar sell-off that we could recover from the NASDAQ collapse, which really was, a gigantic collapse.
I mean, one of my core ideas I'm floating around my head is the 1920s. And what got the US essentially, and the UK, and France eventually, and Germany out of the troubles that they were in was currency devaluation.
Right.
So the US were quite late in repegging because the dollar was very strong. So they kept accumulating gold reserves. And eventually they said, listen, even though we're accumulating reserves, we have to weaken our currency. And almost the moment they weakened it, the economy turned around.
Right. And I think it's exactly the same. And we're at the place where, we've discussed this. Look, the dollar in theory, it could still rally a bit. I don't know. But I think it's late in the game. You could have, if we have another episode where the markets are saying the Fed's not adding enough liquidity, the package stimulus is not getting through enough, the markets correct again, let's say in the next few weeks, and you have another huge dollar up move, right? That's possible. But I think this is an ending move. But that end may be a few weeks, it may be a few months, I don't know. But I think the next 30, 40% is to the downside. So and that's because I think that's really the only thing also that will get Europe to be more aggressive on stimulus, right? Because if Euro heads up to 135, they're going to have to do a lot more. And also China. China still has 3% government bond rates, or 275 or whatever it is. That should be down at 1. And so we have to force China also to be more aggressive. And so if everyone is being more aggressive because we're going to either actively intervene in the dollar, or naturally because of all the excess stimulus, the dollar heads into a bear market, I think you could be in a situation that's like the 20s, where it really is rip-roaring. I'm just saying this is a model I'm working with. I'm not. I see your 1920, the 29 framework where things could be. I think that's more likely if the authorities give up and don't do the right thing.
My view on that is, and again, we're all holding a lot of different scenarios in our heads because we're very unprecedented times. I just think that the probability of a larger solvency crisis based on slow growth is pretty high. And in that situation, I think it's almost impossible to stop the dollar. So I think the dollar has these two windows. One is this now period. And I agree. I really don't know whether the Fed are going to do enough to stop the dollar rising. Maybe if they do, let's say it squirts up again, they try and smash it back down. Okay, fine. My fear is actually give us 6 months time in September, October, when economic growth hasn't really picked up. But we've got this real debt issue. So you've got negative cash flows, negative earnings out of corporations and debt. So, like Ford just got downgraded to junk. We start going through the debt cycle. Now, the worst is obviously abroad because they need dollars. They don't get access to the Fed. The borrowers in the US can get access to the Fed in some way, shape or form. The foreigners don't get it. So that's what drives the dollar. So my fear is there is still a larger potential dollar cycle that is even more toxic. But, who knows?